Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Vince Gethings with Tri-City Equity Group. And today on the show, we have Jill Rodriguez. Jill is the Vice President of Private Banking and Commercial Services at Frankenmuth Credit Union. She handles everything for her business members, including commercial loans, mortgages, personal loans, commercial deposits, and so much more. They can make one call, text, or email, and Jill will get the business done, and I can attest to that, and we'll tell a story later. Jill has just under 15 years of experience in finance and helps her business owners grow their businesses and personal finance. Jill, welcome to the show.
Thank you for having me. I'm super excited to be here.
Yep, I'm excited as well. I think you are our first banker on the show, so it's going to be an awesome episode. Tons of information, literally packed. Every minute of this is going to be fantastic, and I'm super excited for the breakdown here, the questions we get into, and what I mentioned before during the intro. That one text or call and you'll get it done. Like, we were on the call the other night. It was like 9 p.m. and we, just getting it done. So it was, I can attest to that work ethic, and it's very inspiring to see that. So, before we get into it, do you want to kind of introduce yourself a little bit more or?
Well, yeah, just to kind of go over a little bit, just a difference in private banking and commercial services, kind of explain that out a little bit. So private banking, I essentially am at my business owner's beck and call to make sure they're getting taken care of. So, for instance, like we were on the phone, like you mentioned, at 9 p.m. at night, that was what worked around your schedule. So we could get the stuff done, and I don't want to have things delayed. So it is to that extent that whatever my business owners need, they can give me a call and I can get them situated with whatever they need. And if there's something that I don't write, I do write most things, I can get them with the person that they need to be with and get it all arranged and get that set. So for instance, one of my business clients just yesterday called and said, "Hey, I have a thing on this contract. I need to know if I need to get it reviewed." I was like, I know the perfect attorney, got him set up with the attorney. They all touched base and it was done and taken care of within 24 hours. So I parlay my relationships with those outside sources too. So they know if they're going to get a call from me, like for instance, my business owners don't have to contact those outside sources repeatedly. They know I'm going to be doing it. So, and those sources know as well. So it's just better to get stuff done for me as quickly as possible because I am tenacious in a good way.
Absolutely. And I can attest to that and very, very resourceful. Just like we at the meetup where you came in that we had last month, I think it was, where you came in and presented there. And you were just dropping resources like crazy, like, oh, I got somebody for that. I got somebody for that. And just giving so much value out to the investors there at that meetup. So it was phenomenal. And I was so impressed. I was like, we have to have Jill on the show. She can help so many other investors out. Let's give her the platform here. So I guess my first question, we'll start real easy. What is the difference between a credit union and a federal credit union? Because I just realized as I was reading that it's Frankenmuth Credit Union, not Frankenmuth Federal Credit Union. Okay,
so credit unions are chartered differently. So we're state chartered. So basically, a federal credit union, they can do business all over the United States because they're federal. A state chartered, you're within the state that you're in. So, like for instance, I might have some limitations. Like I can work, let's say I have real estate investors in Michigan and the majority of their ownership is in Michigan. We can do other things for them in regards to some items out of state. Like for instance, right now we're doing a deal where we're taking collateral that is out of state for a business owner, but because his business is here, it's located here, we can do that. Whereas a federal is not regulated out by state. They can go out to the multiple states and not have any restrictions. They're layered out there. But you'll come across those restrictions And then there's other ones that are even more strict. Like originally Frankenmuth Credit Union was started through a collective, and we grew up to state chartered. And so the larger we get and stuff like that, the more that we are. So now we're $1 billion credit union, but we're still state chartered. And but we can work, credit unions are a little bit different in regards to banks work with each other too. Cause I've worked at big banks, regional banks, community banks, as well as a credit union in these past 15 years. And there are some other differences that kind of blew my mind in regards to credit unions do, like we do participate in shared branching. So this is something unique. So like you're a real estate investor, you have properties all over the state of Michigan, let's say, and your corporate offices are located in the Great Lakes Bay region where we're all over the place. But then you have some stuff that might be up in Alpena. And you're like, well, I have renters that want to do their deposits and stuff up there. Well, we do shared branching with credit unions out there where they can come and make the deposit and it be all taken care of. You wouldn't necessarily go from one bank and say, hey, I have money I want to put in my account. It's at a different financial institution. Can you put it in there? That doesn't work, but credit unions, it does. So it gives you a little bit more leeway, especially if you're a real estate investor and you have a lot of rental properties. You're not limited to that. So a lot of times they'll like, well, there has to be a branch location there, not necessarily. Plus there's other tools that we can use to get around that as well.
Yeah. And there's things like the, where they can go pay at like Walmarts and 7-Elevens and stuff like that too. I've done that at different properties as well. And there's programs for that.
Yeah. And so, I mean, there's a lot of differences in regards to the credit unions kind of work as a collective to some degree, as credit union says. We call them our sister credit unions, and we work interchangeable with each other to get stuff done. So like, for instance, if there's a credit union that doesn't offer commercial services and they know that we do, that's one of our sister credit unions, they'll refer over and say, hey, you should go check out these guys to get you set up. So
got it.
Yeah.
So what are like the advantages and disadvantages of like a credit union versus like a big bank in terms of, why a real estate investor should care to know the differences?
First of all, at a credit union, you are, as a member, you own the credit union. As soon as you open that membership, you are owner of that credit union. You vote on our board members who are volunteers, and you really kind of drive and dictate the way that we're going. From a banking perspective, and this is just my experience, I'm just speaking in general, that they have their board that they bring on, and it has to go, it's basically what makes them profitable. And if they are privately held, to whether or not they have their stock held, and there's a big difference in regards to that and what changes and what they need to show for profitability and things of that nature. And that makes a huge difference. I've worked at, like I said, I've worked at all of them. And the one thing I really loved about Frankenmuth Credit Union, and it's something I also experienced at the community banks as well, is that we look at the individuals and their deals and not have it as a blanket. We do this. When I was working at a larger bank and we were working on larger deals, there's definitely a very flat structure, and it has to be that way. They're all over the United States. They're dealing with deals 100 million plus from commercial lending. They have stuff broken up in different areas, and they might have stricter covenant requirements. They might have straight policies, because commercial lending is held in-house. They're not selling it. It is on their portfolios, on their books. They're taking in all the risk. So they evaluate their risk across the board. So at one place, and that's why you should check with that, do some shopping. And I would recommend that with all real estate investors, is do shop and see what they have to offer, because there could be blanket things across the board. Like at one place I worked, there was like hotels, restaurants, it was more exception lending. So essentially the covenant requirements were going to be stricter. And in the rates and everything like that, it was a higher risk loan for them. And so that's how they would price it. That's how they set it. And then whereas another place that wasn't the case. And then there's one financial institution I worked at that was like, absolutely, they're not big on construction lending. They weren't big with working with contractors and what they needed done. And then they're and here at Frankenmuth Credit Union, as well as one of the other places I worked, they were absolutely all about the contractors and trying to get stuff set up. So everyone has their own risk factors and different requirements that they need to make. And as a real estate investor, you're not necessarily going to know that until you kind of question and ask your lenders those direct questions and say, what's your appetite for this? Is this the type of lending that you've done in the past? Is this something that you're interested in doing? And really posing the questions to the lender and have them work with you. Because ideally, this is a partnership and they're certainly going to ask you a lot of questions. You're going to have to provide them with a lot of financials and you're going to have to meet their requirements. So it's always good to interview them on your side too, to see if they're meeting your requirements and your needs as well, because it truly is a partnership. And if you create good partnerships, they continue on and you grow with each other. Example for me is that I do a lot of work with various industries, but there were some industries recently with different changes for financial institutions that were it just wasn't a good fit for them anymore, or they're maybe getting exited out because their type of business and their type of lending didn't fit into the new financial institutions lending requirements and the portfolio that they wanted to carry. And so they had to do some shopping and stuff like that. And so basically in talking with them and discussing what their needs and wants were, we were able to create more customized packages that fit their business need. And that's one of the advantages I have always found here where I work now at Frankenmuth Credit Union that I'm able to do. That it's not a flat, this is it, or not, this is what we need to look at and see at the whole relationship, what we can do and what's the benefit for you as well as us and how we can make that relationship grow. So
got it. And so there's a couple big things there that you mentioned is, one was it's vet the community lenders. And for, any listeners that's not in our geographic area, Michigan, these are still things that you're going to want to do to the community lenders in your area is vet them out and make sure that they have a product for the real estate you're buying. Because you might spend a whole lot of time working with a bank just to find out that, they don't even write loans on commercial properties or anything over 20 units or whatever the situation is. Like they just don't even do it. And it's just a hard line and you just wasted a bunch of time. So you definitely want to ask them, what, like to your point, what's their appetite for doing construction loans or to doing maybe interest only periods or 25-year terms. I know some banks are like, nope, we only do 20-year terms. That's all we got. Or whatever it is. So asking those things, prepayment penalties, those are all the things that you're going to want to vet out on your community lenders in your area. And then the other thing was partnerships. This is definitely a long-term partnership. If you don't know by now that your banker is your biggest partner, you need to check a capital stack in on your real estate deals and see who's putting in the most money on your deal. And it's the lender. A lot of people kind of overlook that as that they're, your lender sitting across the table from you, and you're not. You guys are you're on the same side here. As you need to see it that way, that your lender is your biggest partner, and you want to keep them happy so you can develop those long-term relationships.
And overall, your lenders they are invested in this just as much as they are. They have skin in the game, and they want to see you be successful. And when they're asking for things and tracking everything and which sometimes can be annoying, like, hey, we need updated financials and stuff like that. But keep in mind that we're invested in you. We don't want to have to collect on that property. We want you to be successful. We want this to go the distance and then we want to keep that relationship going. So, you're right. We are definitely invested. We definitely have a lot of skin in the game, and are invested in. And when we're looking at the deals, that's why we're assessing our risk and across the board, no matter where I have worked at, that is the standard thing. What's the risk factor? How can we do this? How can we make them successful?
And that's important because, like you mentioned before, with credit unions or the community lenders, a lot of them, those are commercial portfolio loans. It's on the books. And in the context that is when you go to a bigger lender, like a nationwide lender or some big, bank, a lot of times they, I don't know what's the word, it's like securitize this thing, this asset you buy and go sell it to a REIT or something like that, or go sell it to Wall Street, and it just gets folded up. So they're not really, they have like, a checklist that they have to do from, maybe Fannie or Freddie or something like that. And they're going to make sure that, the peg fits in the hole and it's good down the checklist. And if it's good, then they're good. They're going to wrap it up, and they're going to, as soon as that deal closes, they're selling that thing and they don't have to think about it again. Where a community bank, they're taking on that risk. It's going to be on their books, for the duration of that loan for, most of the case, that's what it is. So you understand a little bit why they're a little bit more involved in the process of, vetting you out, vetting the deal out.
Well, and there are also a difference between residential and commercial, because residential, we can sell to Fannie and Freddie, that reduces our risk. But you also want to ask, do they keep it and service it? For instance, Frankenmuth Credit Union, we do service all of our loans. We're not going to sell it. Like, you are always going to be with Frankenmuth Credit Union. We own our own servicing company. So it stays with us. We essentially sell it to ourselves. So and that's a huge piece of that, because especially if you're a real estate investor and you have so many homes and you have them structured a bunch of different ways. And then you have commercial properties, mixed use properties, you have residential properties. If you have them LLC, if you're running them under your personal social and you're doing them Fannie Freddie, those are all different things. And if you have so many different buckets going on, it's a lot easier to keep track if you don't have to worry about one bucket constantly being sold and being switched over to a bunch of different places. So that is a huge piece of that. And there are definitely advantages. The relationship to me is the most important. If you can't trust the person that you're working with, or you feel that they're not as invested as you are, I think that's a big key, because they're the ones that are going to be advocating for the deal for you. Like, we have our own processes here. Like, I have to go to lending committee, and sometimes board for a deal, and I have to present, and I'm your biggest advocate at that point. And so, I'm very invested. I'm very passionate. I am in it. You want to make sure that you have someone that is as passionate about it as you, because really they are your biggest advocate, because their job essentially is to work and do everything they can to get you going, but also analyze the risk for the credit union, make sure it's safe. And then you have those other steps in there, like your lending committees or your boards or whatever, who are also assessing the risk and are going to be harder on it. So it's good that your lender is invested, involved, knows what's going on, asking a lot of questions. So then when they're up in front of them, they can answer it and they have their act together.
Got it. And we'll get into a little bit of that behind the scenes a little bit in a few questions here. But I wanted to switch gears here for kind of the investor. A lot of the as a coach for other real estate people trying to get started in the game, a lot of the questions I get is, how do they set themselves up to be creditworthy, to be lendable? And so, we get into different things that I know that we can kind of get in, different packages that they can kind of put together. So I want to hear from you, what should investors be doing, prior to getting the deal under contract, to set themselves up, for success when they finally do get a deal under contract and they bring it to you. What is like the perfect investor profile? We're talking things like DTI or credit scores or net worth liquidity requirements or experience, and just what is that like? What would the ideal thing, or what are just some tips that investors can do to set themselves up for that?
Well, again, like I said, we're looking at the risk factor. So if if I had two files in front of me and I have someone with an 800 credit score, low debt to income, that's one of the biggest things I would say is make sure you don't have a lot of unsecured like credit card debt that's just being used for play money and things like that. Don't have an excessive amount of debt to where your debt to income ratio is at the top end, because that puts it at a higher risk. And that's for residential and commercial. We don't want to see someone that isn't cash flowing. And that's a huge thing. Cash flow is huge. The credit score goes to the credit worthiness. They're paying their bills on time. They're getting their stuff done. And like you'll see individuals, different national financial advisors who I won't say their names, but they'll sit there and say, you don't need a credit score or whatever, pay off all your debt. You don't need it. It does affect, like there are some financial institutions that will not even do any lending if there is no credit score. And then like, there's no established credit. There's no proof that you've created any history that you've paid payments on time. And then there's other ones that will, but there's not to say that you're going to get the best pricing if you don't have any established credit and show that relationship. So those are huge things. And then a good thing is that you can pull off personal financial statements, and that will really give you an image of what we're going to be looking for, because we're going to ask on a commercial side for a personal financial statement to be filled out. And that's going to go into what your net worth is, your debts, and truly the value of what you have now. Then we're going to be looking at experience. So like if I have two individuals that are looking to, let's say, buy a bakery, and both are credit wise are great, but the one person has had experience either owning multiple bakeries or has worked in a bakery for 15, 20 years, knows how the operations and how that stuff works. So this one person is like, I think it's a great idea for me to buy a bakery, and doesn't have really any of the background and stuff like that. That all takes into account. We weigh that because their ability to manage the business and understand the business, that's another part that we're looking at as well. So there's the straight numbers, which are great, but we're also looking at how much experience do they have doing that at a commercial level. Residential, more that's straight numbers, and that's federally regulated. We the box that you're talking about, that those boxes have to be checked, and those boxes apply to everybody unless it's an in-house loan. But commercial wise, those are in-house lending products, and there are certain things that we're looking to evaluate the risk. Anyone that has more experience in that field is going to have, it's going to show stronger. It's going to be a stronger file. I would recommend minimizing debts, reducing debt loads, so that when we're willing to give you out, let's say you're going in and the first loan you're out is $1 million out of the gate. That's a considerable payment that you're going to be paying on that. We want to make sure that you can handle it. And if you have a lot of debt in other areas that are going to make it so that you don't cash flow, you don't have a lot of discretionary income, once we put that loan on there, because we do look at that. We take what your current income is against the debts, and then we also take the proposed debt, put it in there, and this is how much money you're going to have after. And so we look at how much that's going to be. Is that even a livable income that you're going to have after? Another thing too is, especially when you're looking at real estate investing, getting a good structural team together, I think is important. Having a great accountant, having a real estate attorney, so that when you're looking at good realtors are important if you're looking at residential and some commercial deals as well. Having a good team in place so that you have people that you trust, that you can sit there and bounce the stuff off of, so you don't run into problems before you even get to the lending table. Like a lot of times, let's say you're a business owner and you kind of stepped into doing the business, and you are doing a land contract for the building, and now you want to buy the building. But for the businessman, you wrote off as much as you could because you didn't want to pay out. Well, there's only so much we can add back in. So if your goal, you want to make sure your accountant knows what your goal is, and yeah, you'll have to pay more towards taxes and stuff like that, but that also increases what your cash flow is. So it makes you a stronger file for like lending for those capacities. And again, if you have a good relationship with your lender, you can say, hey, this is what I want to do. They can kind of go through it and they can walk you through the process. If you have a lender that's willing to work with you, even if you're brand new, they'll start walking you through the different steps that you need and the stuff that you need to gather. And getting you set up on the right path. But I really do think a good foundation is make sure you have those other people in place as well. Because especially as your business grows, you don't want to run into issues later. And those people are there to protect you in every way that they can as well.
Got it. No, it's very, very important. So I guess the big thing I got out of that is develop those relationships early and show them, hey, this is what I'm working with. Because they will sit down and dissect where you're at and give you, some action items to work on, even though it might be 6 months until you're ready to actually buy, your first property, or even scale. Maybe you have, a few single families and you want to scale to a commercial property, like a 10 or 20 unit, and maybe you're missing that experience piece or something like that. So definitely be transparent with your lenders, and they can help, pave the road for you where you need to be to make it really easy for you. When it comes time to get those next loans. One thing that I didn't know. So does the credit unions have a net worth equal to the loan amount requirements? I know that's always one that, my new investors always get caught off guard with, where they go, lock up a $1 million property. And I'm like, is your net worth like $800,000? Because it's going to need to equal the loan amount. And they're like, what are you talking about? So is that a common requirement or a common thing that you see?
Again, we look at it, each individual and their deal one-on-one, and we look at that. So we don't set, and speaking of requirements, that goes into like covenant requirements and set structures for different things. Again, each place has their own requirements. So that's why going and discussing things with individuals, like for instance, working with different real estate investors, like we don't have the requirement for seasoning on the cash out refis, where some places have that requirement, either 6 months, a year. You have to own that outright before you can do any cash out refis on the properties. We don't have that seasoning requirement. So that's something that sets us out and apart. But we might have different requirements that other places don't have. So that's why it really is, it's not a blanket answer because every place is different. Like I said, it's really regards to their appetite. For instance, I might look at a deal that let's say you bring me a deal and you're like, well, this is how they're willing to do it. And I look at that deal and I was like, I think I can do it this way. And I think it'd be more beneficial, and we can reduce the covenant requirements and we can set up this and this. And that might be the better structure for you. Again, that's where you're weighing it. And I would advise individuals to get a network of individuals, know as many real estate investors and business owners that are doing this, that are successful and are doing the things that they want to do. Because getting out and meeting with those groups or those individuals and picking their brain, like, where is this at? Because the thing is that real estate investing as well as finance is very fluid. It's constantly moving. It's constantly changing. And being around individuals that are successful, and they can tell you like, well, I ran into this as a problem. I ran into this as a problem. I came across this opportunity. They can give you a lot of different tips and advice and stuff like that. And one of the things to be very diligent of too is looking at your covenant requirements as part of the deal, the prepayment penalties, as well as the documentation that you have to supply and what requirements are within that documentation that you have to supply. Because those covenant requirements come into play, especially when stuff like COVID happens and different things. Also ask what happens if things are going on. Like I know of some financial institution and business owners that when COVID hit, because of the industries that they were in, they were asked and required, even though they weren't late on payments or anything like that, they were required to provide them with audited financial statements and stuff like that quarterly during the COVID 2020 because of the industry that they're in. So being aware of those things with each financial institution, because they all run differently, because again, everyone has their own risk tolerances that they have to work with. But there shouldn't be any problem if they're saying this is what our covenant requirements are going to be, and to ask them what that entails. Like one lender might do a 1.2 debt service coverage and require that you have so much cash liquid that could be accessed. Another one might not have that cash requirement, but have that same debt service coverage or a higher debt service coverage. Yeah. So every deal is very customized and different. And having a network and then constantly learning, I think, is a very important piece. Reading as many books, looking podcasts such as this, and anything you can do to grab, because the industry and everything is constantly changing and risk tolerances are changing. Mm-hmm. For instance, before 2020, speaking to real estate investors, when you're doing the commercial buildings, there was, like, if you did a commercial building, you're looking at who the renters are going to be and stuff like that. With 2020, that changed how people did business. And so, like, people were already starting to work more remote. But after 2020 hit and people were forced to work remote, and companies realized that they could get by with that and could reduce their overall rental expenses, they reduced the square footage that they needed in commercial rental space. That changed. Now, if you're the owners of those buildings, how do you adapt and make those changes? So an example I brought up before to you is, like, there's one individual that had a commercial space, and instead of, he set it up where the digital marketing could be set up where he could rent that same space out during the week to multiple people, like whether it be fitness people or investment people or whatnot. He could have up to 5 renters running out that same commercial space because of how he structured it, because the tenants that he had reduced the space that they wanted because they could have more people work from home. Changes like that affect how we look at the risk tolerance of taking on the lending as well. Got it.
So couple of things there. One is to be adaptive as an investor, and we all know that. And the other one is definitely ask a ton of questions. You know, when you're talking with your lenders, don't assume that, you know, this lender over here is going to have the same requirements as this lender here, and they're all the same. Because from what we've learned in the last 40 minutes is that, you know, every lender is going to be different, especially when you're talking at the community lender level. So you really got to get specific on like I said, the net worth liquidity requirement, just things as a borrower to get yourself set up. And also at the deal level, you know, do they require what's the, you know, what are the minimums or the stipulations on, you know, different things on the deal, down payments, interest only periods, construction. Definitely just got to ask all of those questions of what they offer. So what are some red flags or common mistakes that newer investors make when they come to you maybe for their first loan or first commercial loan? What's like some of the common things that you see?
A lot of times they haven't really run numbers really, or even did the research on numbers before they're like, go off and sign a purchase agreement, because they're like, oh, I can get this. And they don't do the research, the background in it. I do see it a lot when our first people are getting into real estate investment and they're like, this is going to be my first rental. They might not do the research that's needed in regards to it. And if your goal is to have a lot of rentals, and especially with mixed use properties and stuff like that, this is where coming into play those accountant and attorneys that can advise you on different things. Like, I don't know too many attorneys that would say, hey, put this all under your personal social so that if those renters have any problems, they can come after you personally, as opposed to putting it in its own EIN number, its LLC, and getting that situated. And a lot of times that's a big thing, is that they haven't done the research. Another thing too is that they don't figure in any of the additional costs, where there's going to be costs for appraisals and things like that. And they don't analyze what their cash flow truly is in taking on that new debt. So, and then they also don't, because they're not doing that back research, they're not really putting together a business plan and not thinking out that process, because the lenders are going to be asking, do you have a business plan, or straight just asking questions. And when it comes down to it, are the numbers going to match out? And then also, do you feel comfortable with their knowledge base? Because if they're not able to answer like some of the basic questions that you know are going to be coming up, those are all red flags as a lender that increases our risk if they're not prepared, if they haven't done the work themselves in advance before jumping on. That means you're kind of just throwing a deal together. And for our point is that we do have skin in the game. And then a lot of people will push back on doing like guarantees or being co-borrowers on their own loan. That is also a red flag. If you're not willing to like guarantee your own investment, why are you asking us to put up our money for, if you're not willing to, like, you're basically saying you want us to put up this money, but if anything goes wrong, you don't want to put your guarantee on it. You not being invested, whether it be guaranteed or co-borrowing or something like that, especially if you're brand new at this, it's a much different conversation when you're talking a huge entity that's a big corporation with a $200 million book of business, them guaranteeing, and it's a corporation compared to, hey, I'm an LLC and I'm just starting and I don't want to give you my guarantee on this. Those are things that are all weighted and looked at. So I think one is that you got to do the research, got to get the education because it affects you financially, because you might have lenders that will write the loan and are willing to call it. But if you're not even doing the research, you're just really putting that to the lender, where they could require a lot of covenants and stuff like that, because things that you could have done in advance that would have reduced the risk for the lender, you didn't do. And that increased risk affects the deal that you're going to get and on the outside, or if you're even going to get the deal.
Got it. So do your homework and be ready. Business plan, financial analysis. That goes to like just example things like get, insurance quotes and get the new tax rate, because a lot of people forget that taxes often change when you close. The taxes are going to get reassessed in most areas of this country. So what is the new tax rate? Are you in a flood zone? Do you require flood insurance? What's that going to be? So do the research on all of those things to show that you're prepared for this business venture.
Mm-hmm. It's a huge piece. And that's why having that crew of people in advance is really good, because they are experts in their field and they really can help you and protect you. Like, for instance, something that just happened. I had someone just yesterday where they had signed a purchase agreement. And the way the purchase agreement was structured, the seller who was writing the purchase agreement, how he had the business structured, technically wasn't the person who could be writing the purchase agreement and agreeing to the sale, which that would affect everything. And that's where a real estate attorney can pop in and do that and get that stuff fixed for you on that end, because it affected the deed, title, and everything like that. Is a pretty complex deal. And that little detail of how he had it structured on his side did make a difference on the overall. So it's important to look at those items and see and have those people in place. I think that is one of the biggest things, that when someone starts off with me, if they don't have people in place, I'm like, hey, let's get you situated with these individuals. These would be good advocates. And I also try to connect business owners with each other too, so they can exchange knowledge and everything like that to help grow. Absolutely.
You've done a great job with connecting investors and then also other resources in the community as well. Like you said, the lawyers and the attorneys and stuff like that. So it's been great. What else do we have here before we get into the final fire round? Okay, I got one here. So real quick, like 10,000 foot view, what happens? Like, what is the basic process if somebody calls you or shoots you an email and say, hey, Joe, I got this property under contract. Here's my purchase agreement. Here's my folder with my personal financial statement, my taxes, whatever you require. Here's everything. What happens from there all the way to the final loan commitment? Like just kind of the different steps.
Okay, so just overview, and this is how I kind of do it here, is that I look at your deal and we'll set like rate, terms, and everything like that. I'll discuss it with you and see where we're at. And in my case, I I make sure that I'm good on that with lending committee in advance. And then I spread it. I get it sent over to our credit analysts, and they spread out the numbers. They go through your personal financial statement, your tax returns, all that stuff, to kick out and give me a overview of your financials. And then once I have that, I go to lending committee with the final, get approval for the loan. And at that point, I come back to you and say, hey, do you want to keep moving forward with this? This is the final terms. This is what we're going to do. Because now everything we're going to do now, ordering appraisals, or depending if it's a commercial building, if it's got to be an environmental ordered, and different things like that. Now I need your approval, because all these things are going to be cost you money, because everything kind of doing that before that doesn't cost you a dime. I'm just evaluating whether or not it's a good relationship for both of us. But once you're approved, and then I need your permission to continue forward. And then that would be the next piece. And then once those elements come back in, the appraisals and all that stuff, then we can book closing and get your documents. Depending on the document level, like I have business owners that want to see their documents 2 weeks beforehand, a week beforehand, a day beforehand. Some that have worked with me for a long time are like, just send it over day of, and they'll just do an overshoot of it. And they're good to go on signing off on the documents.
What about, so I know community banks and credit unions, they do a lot of, you hear the things like, committee or the board. What does that mean?
So your loan officer doesn't get to make the final decision on that. You have people that are set in place. And there's definitely every place is different. Like each financial institution has their own kind of like structure. So like for me, I have a lending committee. I have certain people that are within the lending committee that are designated within the credit union that are part of that. And I take all my deals to them. Now, depending on complexity, size of a loan, size of the relationship, it might be something that will go to the board, especially if it's something that's very much on exception, like something that is trickier, has a lot of elements to it, that will go to our board for final approval as well. And that's just to make sure that we're doing our due diligence and matching up. And it all falls into whatever each place's lending policy dictates. So everyone has a lending policy that structures out what their procedures are going to be, what type of lending they can do, and all of that good stuff, what lending limits are and things of that nature. So it all falls into that. And each place is going to have a different set of structures. That is the pluses and minuses of commercial lending, is that because it's in-house, everyone has their own risk tolerances and has their ability to do a bunch of different things. But for real estate investors, it's a little bit harder, because you do have to do a little bit more work. Whereas if you know it's a Fannie or Freddie loan, it's going to be the set of boxes that you have to hit. But again, on the commercial lending side, there's a lot of advantages to doing that in a lot of different structures. Like a deal, any deal that you have, if there's something that is needed, like you could possibly do on a new construction, we can expand out the new construction based off the delays that we're having on COVID on a commercial deal up to the interest only period can go much further. We don't have to sit with a certain set of restrictions, and we can also add interest only periods for stabilization on a new building that someone just bought, or so they can get it rented up as part of the deal. There's a lot more room to play with in there. And the better relationship you have with financial institutions, the easier and better. I feel that because you have the relationship, they know that you're good at paying and stuff like that. It's a lot easier, and you move through the process faster, including doing the spreads and everything like that, because they're not starting from ground one. If you come in with your LLC and say, hey, I want to do this deal, then the next time you come in with a deal, they already have the foundations. They just add in that new deal and kick out the spreads faster.
Very interesting. Okay, good stuff. Any last bits of advice before we head into the fire round?
I guess my biggest piece of advice is make sure that when you're talking with your lender and you're doing the interviewing process with them is to kind of be prepared with the questions in advance and kind of know, and then know where to feed off of, because you, like I said, it's a partnership and you want to make sure the partnership is good for both of you. And they are definitely going to have their own set of questions that they're going to have for you and documents they're going to gather. So be prepared. And then also you might get asked for other documents. You might get asked other questions. I've had people that are reluctant to give those documents and stuff like that. Well, just know what we're trying to do is put a deal together based off the financials and having the most information. If we're asking for more information, then we want to make sure that we're structuring the deal the best. Don't be reluctant on documents and slow about getting documents over to the lender, because that slows you down overall as well.
Absolutely. Good stuff. One of the best things I got of advice was, have a folder on your computer or Drive or whatever. I use Google Drive. That way I can access this folder anywhere. It's kind of my evolution. So I have a Google Drive folder with everything in it. It has all my taxes in it. It has my personal financial statement, my schedule of real estate owned. I usually keep it up to date with like bank statements, and all that stuff is in a Google Drive folder. So, because whenever you're going to talk with a banker, that's going to be the first thing that they're going to ask is like, well, send over this, this list of documents, and I can literally just start an email and drag and drop it right from my Google Drive and have it to them in a few minutes. And that really shows that you're prepared, you know what you're doing, and you're ready to take on this investment, rather than, like you said, waiting weeks to, I have to pull my taxes out of some box somewhere from 3 years ago. You need to be a little bit more professional about this venture here. So that's one of the things I do is I have a Google Drive folder with all of those documents already ready to go. And every, quarter or so, I'll go in and update whatever I need to update.
That is excellent, and your lenders do appreciate it. So for sure, it's definitely a benefit, and it's a benefit to you as well.
Got it. Yeah, absolutely. It's a lot less stress for me because I don't have to keep looking for the same documents all the time. All right. So the fire round, again, it's the same questions that we ask everybody. So just first thing that comes to your head, or things that you've already kind of noted, right? So what is the best book you recommend other than Rich Dad Poor Dad?
I like Warren Buffett's essays. And beyond that book, like I said, I'm an avid reader and I want to try to gather as much information as possible. So I kind of try to pull from a bunch of different sources. And I also pull different industry things too, because I work with multiple industries. I want to know what's happening for each of my clients and what are some advancements and things that could help them in their business fields as well. So for me, I'm never not involved with a lot of different things. Like I have different online things I look at for all different industries, like medical, real estate, construction, where a lot of my clients' livelihoods are. So I'm up to date so that when I'm with them, I can say, hey, well, I saw this or whatnot. And sometimes I'm bringing something new to them that they hadn't seen yet. And then other times I find ways to connect the business clients where it's an advantage for both of them to get a relationship.
So what book are we going with?
Warren Buffett essays.
Okay, got it. The Warren Buffett book, essays. So you're talking about the Berkshire Hathaway essays, or?
Yep.
Okay.
Yeah. And Warren Buffett's pretty good to read.
Yeah, absolutely. I've read, the Warren Buffett Way and Snowball, and those books are really good. All right. So what is your superpower?
Manifesting. I think I set my goals, structures, and I manifest what I want in life. So I feel
awesome.
Like
that's
power.
A good one. I do that. I do visualization and manifesting and all that kind of stuff of writing down, my future goals as if they've already happened. It's worked well so far. And I keep knocking them down, my milestones and my goals. So I'm going to keep doing it. All right. What is the biggest lesson you've learned over your career?
To always learn and listen, and to be very it all falls in together. Learn, listen, and to be adaptable. They all kind of fall in together as one kind of key piece. And I, like my mentor always said, that the biggest thing is that you do the follow through and you listen to the people that you're working with, because that is the most important thing. And so I think that is a key piece of my success, is that advice that I was given early on.
Awesome. Good stuff. And then last question, how can our audience get in touch with you?
Well, you can always reach out to me right through Frankenmuth Credit Union. And then that is the easiest way. You can go right to our website, frankenmuthcu.org. Or you can look us up and Google us. We are all over the place, and ask to reach out to me. And then I can provide to you as well links so they can reach out if you have a place that you can pop them on there.
Sounds good. Well, thank you for being on our show. This was a lot of fun. Very, very, very informative. And yeah, we look forward to speaking soon and getting you out to Hawaii for the conference out there.
I know, I'm excited. So it's a good time. So I'm excited, and I can't wait to get out there and also just to see what other questions and stuff people have for me.
Yeah, it's going to be a lot of fun. Well, that's all I have for you on this show. And yeah, for our listeners, see you next time. Man, that was a great episode with Jill over there from Frankenmuth Credit Union. Tons of information in there. I'm going to go back and re-listen to this again and look at my notes, all the ones I took about, make sure you have your business plans tied up, your analysis tied up, make sure you have a folder with all your personal information before you go to the lender. So it makes it really easy for them to approve you, make you credit worthy for them. So remember, the lenders are your biggest partners. Don't think of them as like some kind of adversary across the table that you have to win something from. It's they are your biggest partner in your deal. So treat them accordingly. So if you found value in this podcast, please subscribe, give us a review on Apple Podcasts or Spotify. And if you know anyone else that might resonate with today's show, please share this episode with them. And then also, because we're getting ready for the Hawaii Millionaire Mindset Conference, the Blueprint, we would love if you joined us and other top industry leaders for motivation, training, and of course, lots of networking in the great Hawaii island of Oahu, in the resort Ko'olina, and specifically at the Four Seasons in the Ko'olina resort is where this conference is going to be. July 21st through 24th, 2022. So block off your calendars. It's going to be a lot of fun. Right now, we are doing early bird specials on tickets. So you're definitely going to want to go to the millionairemindsetblueprint.com and register and get into these tickets here. Book your family. Make this a business vacation where you can take your family, go out to Ko'olina. They got Disney Alani there. They got the Four Seasons. They have all the things out there, the lagoons to swim in and stuff like that. It's a lot of fun, and then turn it into a business trip as well. That's what I'm doing. I'm bringing my family out next July, and it's going to be a blast. So check it out, millionairemindsetblueprint.com. All right. See you next time.